Welcome to Quantum Metals. This is not a channel about hype, fear, or short-term predictions. This is a place for people who want to understand what's really happening beneath the surface of the global financial finance. While headlines focus on prices, we focus on structure. While the crowd reacts, we analyze, because real wealth is not built by chasing noise, it's built by understanding cycles, recognizing signals early, and positioning before the shift becomes obvious. What you're about to hear is not speculation, it's perspective. The world you are living in today is not the world you were prepared for. You were taught to trust numbers on a screen, digits in a bank account, promises printed on paper. But history does not respect the expense. History respects value. And value has always followed one simple rule: it must exist in the real world, not in someone else's balance sheet. Every major financial collapse begins the same way. Governments overspend. Debt explodes, confidence quietly erodes, and while the public is distracted by headlines, entertainment, and political noise, the system underneath is being reset. Not loudly, not overnight, but slowly, methodically, and always at the expense of savers. Fiat currencies are not money. They are currency. There is a difference. Currency is a tool of control. Money is a store of labor and time. When currencies fail, and they always do, the losers. Roman coins were once pure silver. By the end, they were dusted with it. Empires don't collapse when people panic. They collapse when people lose trust. Right now, we are watching the largest experiment in monetary history, trillions created from nothing. Interest rates manipulated, markets propped up by confidence alone. This is not stability. This is delay. And delay is always followed by consequence. Here is what most people miss. Inflation is not rising prices. Inflation is the destruction of purchasing power. When your money buys less, your life becomes smaller, your future becomes more fragile, and your freedom disappears. This is not accidental. It is structural. Throughout every financial reset, everyone, without exception, tangible assets survive. Land, energy, and above all, precious metals. Gold preserves wealth. Silver preserves survival. Silver is not just a metal. It is an industrial necessity, a monetary metal, and a historical anchor of value. It is used, consumed, and increasingly scarce. Silver is different because it sits at the intersection of money and function. It is required for technology, medicine, energy, and defense. Unlike paper, it cannot be printed. Unlike promises, it does not default. And unlike digital numbers, it does not vanish with a policy decision. When confidence breaks, and it always does, capital runs to what has no counterparty risk, no debt, no signature, no promise, just wait, just measure, just truth. The next reset will not look like the last one. It will not be announced. It will not come with warnings. It will come quietly, through purchasing power loss, through market volatility, through temporary measures that never reverse. The question is not whether the system will change. The question is whether you will be positioned on the right side of that change. Because when currencies reset, those who prepared are called lucky, and those who didn't are told it was inevitable. The banking illusion and debt trap. Most people believe their money is safe because it sits inside a bank. They believe numbers on a screen represent ownership, but banks do not store wealth. They manage liabilities. Your deposit is not your money. Set in a vault, it is a loan you gave to the bank, and that single misunderstanding changes everything. Modern banking is built on confidence, not reserves. For every unit deposited, only a fraction actually exists in liquid form. The rest is leveraged, rehypothecated, and exposed to risk you never did enter to. This system works only as long as people don't ask for their money back all at once. The moment confidence cracks, the system freezes. This is why bail-ins replaced bailouts. In the past, governments printed money to save banks. Today, the policy is simpler and more dangerous. Your deposits become the rescue fund. If a bank fails, your money is no longer guaranteed. It becomes part of the restructuring. This is not theory. This is written policy across many developed economies. Debt is the engine that drives this system. Governments are not trying to reduce debt. They cannot. The debt is too large to be paid back, honestly. The only way out is devaluation. Inflate the tourney. Reduce the real value of what is owed. Transfer the loss silently to savers. When interest rates rise, debt becomes unmanageable. When rates fall, currencies weaken. There is no safe path left. This is the trap, and every central bank is inside it. People are taught to fear volatility in metals and commodities, but volatility is not risk. Permanent loss of purchasing power is risk. A savings account yielding less than real inflation is not safety. It is a guaranteed loss. This is just stability. This is why tangible assets matter. Not because they are exciting, but because they are outside the system. They do not depend on bank solvency. They do not depend on policy credibility. They do not depend on political logos. Silver plays a unique role here. It is small enough for individuals, liquid enough to exchange, essential enough to be demanded regardless of monetary conditions, and undervalued relative to its historical role. When financial systems strain, silver doesn't need permission to matter. Paper claims on metals are not the same as metal. ETFs, derivatives, and contracts multiply claims far beyond what exists physically. This works until it doesn't. And when it doesn't, paper settles in tourney, not in metal. That difference becomes everything. Every financial reset follows a pattern. First, denial, then control, then restructuring. Capital controls arrive quietly. Withdrawal limits are called temporary. New rules are justified as protection. And by the time the public understands, the exit is already closed. Preparation is not panic. It is awareness. It is positioning before necessity forces your hand. History rewards those who move early, not those who move fast. The system will not warn you before it protects itself. It never has, and it never will. The silver supply shock and inevitable repricing. Silver is not rare because it is scarce in the earth. It is rare because it is consumed. Unlike gold, which is stored and recycled, silver is used up, embedded into technology, medicine, energy systems, and infrastructure that modern life cannot function without. Once used, much of it is gone forever. This is the part most people miss. Demand for silver is no longer driven by investors alone. It is driven by industry. Solar panels, electric vehicles, advanced electronics, medical equipment, water purification, defense systems all require silver. And this demand is not optional. It is structural. It grows as technology expands, regardless of price. At the same time, supply is constrained. Silver is rarely mined on its own. It is mostly a byproduct of mining for other metals. That means production does not rise simply because silver demand rises. If base metal mining slows, silver supply tightens even as demand accelerates. This creates a pressure point. Above ground inventories have been declining for years. Stockpiles, once considered abundant, are being drawn down quietly to meet industrial needs. What was once excess has become essential. And unlike paper markets, physical silver can't be created with leverage or accounting entries. The price, however, does not reflect this reality. Why? Because price discovery happens in paper markets, not physical ones. Futures contracts, options, and derivatives trade volumes many times greater than the actual metal. These markets set price based on liquidity and leverage, not supply and demand of real ounces. This disconnect can persist until it can't. When industrial users require delivery, when mints cannot source material, when inventories fall below critical thresholds, paper promises face a test they cannot pass. At that moment, price must adjust. Not gradually, but violently. This is not speculation. It is mechanics. Silver has always lagged gold in the early stages of monetary stress, and then it moves faster. Historically, silver compresses for long periods, absorbing pressure before releasing it in sharp, rapid repricing events. Those moves do not wait for consensus. Most people try to time the moment. That is the mistake. By the time headlines confirm the shift, the opportunity has already passed. This is why positioning matters more than prediction. Physical ownership removes counterparty risk. It removes reliance on clearinghouses, exchanges, and settlement systems that fail under stress. It transforms silver from a trade into insurance. And insurance is not bought when the house is already on fire. Governments cannot increase supply. Central banks cannot print ounces. Technology cannot substitute silver at scale without cost. The constraints are real, physical, and tightening. When monetary trust erodes and industrial demand collides with limited supply, price is forced to reflect reality, not policy. Silver does not need belief. It needs necessity. And necessity is already here. The question is not whether repricing happens. The question is, who is prepared before it does? Every monetary system ends the same way, not with an announcement, but with a transition. Confidence fades quietly. Rules change gradually. And by the time the public realizes something fundamental has shifted, the structure has already been replaced. This is how resets happen. They are never presented as resets. They are framed as solutions. Digital systems for efficiency, new regulations for stability, temporary measures for protection. But beneath the language lies a single objective: control of capital flows in a world drowning in debt. Currencies lose credibility when they are overissued. That credibility cannot be restored by policy statements or rate adjustments. It can only be replaced by restructuring the system itself. History shows that when trust breaks, authorities don't ask permission. They redesign the rules. This is why the window matters. There is always a period before controls tighten, before access is restricted, before choices narrow. That window does not stay open indefinitely. It closes when preparation becomes popular. It closes when demand overwhelms supply. It's when stability narratives fail. Most people wait for certainty. But certainty only arrives after opportunity disappears. Wealth is not created during a reset. It is repositioned before one. Those who hold assets inside the system are exposed to its changes. Those who hold assets outside the system retain optionality. That thus defines outcomes. Silver occupies a strategic position here, not as a bet, not as a trade, as a bridge between monetary history and industrial necessity. It functions in both worlds, store of value and dispensable material. This dual role is why it has been underestimated and why it becomes critical during transitions. As currencies weaken, purchasing power seeks anchors. As technology expands, industry competes for limited resources. These forces converge. When they do, repricing is not a choice. It is a requirement. The reset will not reward complexity. It will reward simplicity. Tangible assets, clear ownership, minimal counterparty exposure, paper, claims, promise, convenience. Physical ownership provides certainty, and in periods of restructuring, certainty carries a premium. The greatest risk is not volatility. It is dependency. Dependency on systems that must change to survive. Dependency on promises that cannot be honored in real terms. Preparation does not require perfection. It requires intention. Understanding that what protected wealth yesterday may not protect it tomorrow. And acting before necessity removes flexibility. This is not about fear. It is about awareness. Every cycle transfers wealth from the unprepared to the positioned, from those who trusted narratives to those who understood structure, from those who waited for clarity to those who moved during ambiguity. The window is still open, but it is narrowing. When the reset becomes visible, positioning becomes impossible, and when silver's value is obvious, accessibility disappears. History doesn't repeat itself exactly, but it rhymes closely enough to recognize the pattern. The only real question left is simple. Will you react to change, or will you be ready before it arrives? If this perspective added value, make sure to like the video and share it with someone who needs to hear it. Subscribe to Quantum Metals so you don't miss what's coming next. We'll continue this conversation in the next video.